When people begin thinking seriously about retirement, one of the most common questions is simple. Will my money support the life that I want? That question is understandable. Retirement often brings a shift from saving money to using the assets you've built up over time. And that shift can change how investment risk feels. In our planning conversations, we often organize retirement concerns into three broad areas: income risk, market risk, and tax risk. Today, we're going to focus on one part of that, and that's called market risk. And that can be especially important for retirees and pre-retirees. Sequence of returns risk. This is an educational overview. Your situation will be unique, and any investment, income, or tax-related decision should be considered in the context of your full financial picture. Most investors understand that markets move up and down. That's a natural part of investing, and it's completely normal. But for someone who is still working and adding to their accounts, market declines may feel different than they do for someone who is retired and actually taking withdrawals from those accounts. This issue is not only whether markets decline, the issue is when those declines actually happen. A market decline early in retirement while withdrawals are being taken can create more pressure on a portfolio than the same decline later in retirement. This is the core idea behind sequence of returns risk. Sequence of returns risk refers to the order in which investment returns occur. Two retirees can experience similar average returns over time, but if one person experiences negative returns early while also taking income, their outcome may look very different from someone who experiences stronger returns early. This matters because withdrawals during a down market may require selling investments when values are lower. That can leave fewer assets available to participate in markets later on when markets recover. So the planning question becomes less about trying to predict the market and more about building a thoughtful process for how retirement income may be taken across different market environments. So here is a hypothetical example of two brothers, each retiree with $1 million in their IRA. Each plans to withdraw $40,000 per year for income. One brother retires in 2000, the other retires in 2010. The example shows that the timing of market returns can make a significant difference when withdrawals are being taken. The brother retiring in 2000 experienced several difficult market years early in retirement, including the early 2000s and 2008. In the illustration, his IRA balance declines substantially over that 10-year period. The brother retiring in 2010 experienced a more favorable sequence over the following decade. In the illustration, his IRA balance grows even while taking the same annual withdrawal. The key point is not that one time period should be expected in the future or that the illustration represents a personal investment plan. The key point is that the order of returns matters when income is being taken from the portfolio. This is why retirement income planning is different from simply choosing investments. A retirement income strategy may need to consider questions such as how much income is needed from the portfolio, which accounts may be used first, how much flexibility is available in spending, what level of market exposure is appropriate, are there cash reserves or other income sources that could help reduce the need to sell investments during a difficult market period, how do taxes, required minimum distributions, and other planning factors fit into the overall picture. These questions are individualized. They depend on your goals, resources, time horizon, risk tolerance, income needs, and the broader financial plan. At Montgomery Financial, our role is to help organize those moving pieces into a planning process. We believe retirees and pre-retirees benefit from understanding not just what they own, but how those assets are intended to support income, flexibility, and decision-making over time. As you prepare for your first meeting, this concept is helpful because it gives you a practical place to begin. We are not starting with a prediction about the markets. We are starting with your life, your income, your needs, and the decisions that may need to be made along the way. In our conversation, we will aim to better understand your current financial picture, what retirement means to you, and where you want to add additional guidance. Sequence of returns risk is one reason a personalized retirement income plan can be a valuable tool.